Hello, my name is Eddie, and today I'm gonna walk through quarterly balancing analysis for moderate risk clients with $1 million dollar portfolio. The client is allocating his portfolio in 40% US stocks to 20% international stocks and 30% bonds and 10% real estate. The goal of this analysis is to review the portfolio after quarter one 2024 market movement, uh, calculate and decide if we need to um, rebalance the portfolio comparing to the drift. So at first stage, we identify the client's profile, which um, the client has $1 million starting and 40% in US stock and 20% in international stock and 30% in bonds and 10% in real estate. For this project, I decided to use 3% as the drift for when deciding whether whether or not to rebalance the portfolio. Um, and then the transaction costs are $50 per trade and plus 1% of the trade amount. And then the quarter one return were uploaded to the system, which US stocks has 15% return, international stock have a 15% return, bonds has a negative 3% return, and real estate has 8% return. When running this first step, when running this portfolio, we upload all the informations with a confirmation, which is connecting right now. It was successfully run before, and then for the second stage, we calculate the the weight and the profile after the quarter one gain or loss, which for each asset it's gonna time its weight and then apply the quarter one return, which is one plus the percentage of the return. And then the system calculates the new weight after the gain or loss in quarter one and compare it to the drift, which is with this part of the code, comparing it to the drift. And then the system will plot um, the old and the new portfolio allocation just for a better visualization. After that, the summary table was printed for summary review. Yeah, let's run this code. After running this code, the plot will show the original profile allocation and the current allocation after quarter one, which is US stocks as 42.2% after the gain, and international stocks is 21.1%. The bonds are 26.7%, and the real estate is 9.9. And then the table shows the initial weight and the current weight. The drift is um, current weight minus initial weight, and it also shows how much the both each asset has the value of each asset after the quarter one gain or loss. From this table, we can know shows that the table shows us when comparing to 3% drift, the the bonds was off by 3.2%. So the rebalancing will be needed for this profile if the drift is 3%. The drift allowance is like 3%. And then the system will, for this part, system will take the drift for each asset and compare it against the um, drift allowance, which was set initially. And then the system will calculate how many trade it needs and um, how many whether the this asset needs to sell or buy. The system then will calculate the fees for each trade, which is $50 plus how many uh, 1% times the asset we need to buy or sell. Then for this chunk of code, will will present the rebalancing results if the portfolio need to be rebalanced, which shows how much trades in it and the cost of the rebalance. All right, let's run this. The table shows um, the new the table shows the new portfolio after rebalancing, which 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 sold um 20 24,400 for of US stock and 12,200 of international stock and bought which and bought 35,700 bonds and 900 real estate to rebalance it to the initial um portfolio allocation for all the all the assets. It also shows the transaction cost of selling and buying these assets, and the total cost of this rebalancing will be $273.20. And then we'll check for um, total equity exposure, which checks if the equity is more than 60%. But so um, currently we need to rebalance it, but we don't know if the equity is over 60%. And then it will check for if it will check the it it check the drift of the equity exposure comparing against 60%, and then print the result. Our portfolio is the portfolio after the first quarter of 2024 has a equity exposure of 63.4%, which is high, which has a drift which maximum drift from the target is 33.3%. Um and then forgot to say this part. Only also check for the cost as a percentage of the portfolio, which $273.2 is 0.025% of the portfolio. And then for the last part, the system check will check if the balance is if the balance is needed, because Um, the for this part, I assume that benefit for rebalancing will be 1%, 0.1% improvement of the portfolio, which is $1,089 for this portfolio. This one will compare it against the spending of rebalancing, which is $273. Um, and then justify this, um, which the benefit is higher than the cost. So if we are doing the perfect balancing for for each uh for 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 each case, which means balancing every time when um the portfolio is has any drift to initial profile allocation. By when doing that, we'll rebalancing would cost a lot when there are not not much um when there are not much when there are not much benefit from it. By sticking with 3% threshold, we're maintaining the system will maintain discipline and protect the net returns. But when the trading trading cost is low, I think the thresholds could be lowered for because of the trading cost is very low. And yeah, I think rebalancing is essential, but it works best when we balance with recheck with the predicted benefit. In summary, the this project was very clear, um, showing the power of rebalancing decision. First time I used 5% as a threshold, which didn't trigger any rebalancing event. So I changed it to 3% to um, just for testing purpose to trigger rebalancing when when you need to calculate the trading trading value and trading cost. Thank you for watching.